A three-digit number. That's it. 3 digits between 300 and 850, and it decides whether you get the apartment you applied for. It decides whether your car payment is $340 a month or $520 a month for the exact same car. It decides, in some states, whether a company will even interview you for the job you want. No one voted on this. No one asked you. One day a system existed, and your financial life was handed over to it. Here's what makes this stranger. Most people living inside this system don't understand how it's calculated. They don't know which of their actions help it or hurt it. They don't know that the rules can be learned, and that once you learn them, you can engineer a score that works aggressively in your favor instead of quietly against you. This video is that education. By the end of it, you will understand the credit score system better than 90% of American adults. You'll know exactly what moves your score, what the myths are that cost people thousands of dollars, and what the specific deliberate steps are to build a score that opens every door it touches. Let's start at the beginning. The modern credit score was created in 1989 by a company called Fair Isaac Corporation. You know their product by its initials, FICO. Before FICO, lending decisions were made by loan officers using judgment, gut feeling, and criteria that were often discriminatory: race, neighborhood, gender. The system was broken, inconsistent, and deeply unfair in ways that destroyed communities. FICO's argument was reasonable. Replace human bias with math. Create a standardized, objective measure of creditworthiness based on behavior, not identity. In theory, this was progress. In practice, here's what happened. The formula became a product. FICO licenses its scoring models to lenders and charges them to access your score. Equifax, Experian, and TransUnion, the three major credit bureaus, collect your financial data and sell it back to lenders who want to evaluate you. You are not the customer in this system. You are the product. The bureaus are for-profit companies. They profit when lenders access data. Lenders profit when they have more information to price risk. The entire ecosystem is built around one thing: accurately predicting whether you'll repay debt, and it has evolved over 35 years into a system so embedded in American life that opting out of it is nearly impossible. You can't buy a house without a credit score. You can't rent most apartments. You can't get most car loans. For most people, refusing to participate isn't freedom. It's just a harder life. So you play the game. The question is whether you play it on accident, drifting through decisions that affect your score without understanding what you're doing, or whether you play it deliberately, knowing exactly which moves build the score that gives you access to the best rates, the best terms, and the most financial flexibility. This video teaches you to play deliberately. Your FICO score is calculated from 5 factors. Each one has a different weight. Understanding the weights tells you exactly where to focus your energy. Factor 1. Payment history, 35%. This is the biggest one. More than a third of your score comes from one question. Do you pay your bills on time? Not mostly on time. Not usually on time. On time every time. A single missed payment 30 days late can drop your score by 80 to 110 points depending on how high your score is. The higher your score, the more a missed payment damages it. Because the system is essentially saying you had more to lose. That drop doesn't fade quickly. A 30-day late payment stays on your credit report for 7 years. A 90-day late payment stays for 7 years. A bankruptcy stays for 10. The most important thing you can do for your credit score costs nothing and takes 20 minutes. Set up autopay on every account for at least the minimum payment due. Not because you plan to only pay the minimum, you should pay in full when possible, but because autopay ensures you never accidentally miss a due date. Late payments don't happen because people are irresponsible. They happen because people are busy. Automation removes the human from the equation. Factor 2. Credit utilization, 30%. This one surprises people more than any other factor. Credit utilization is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and you're carrying a $4,000 balance, your utilization on that card is 40%. Lenders get nervous when they see high utilization because it suggests you're stretched thin, that you depend on credit to function. The scoring models penalize it heavily. The general guidance is to keep utilization below 30%. But here's what the guidance usually leaves out. Below 10% is significantly better. People with the highest credit scores typically have utilization in the single digits. Here's the counterintuitive part. Having credit cards with high limits that you barely use is good for your score. A card with a $15,000 limit that you never use is contributing $15,000 of available credit to your denominator, which drives your utilization percentage down. This is why closing old credit cards, especially ones with high limits, can hurt your score even if you never use them. You're not just closing an account, you're shrinking your available credit and increasing your utilization percentage. Keep the old cards open. Use them occasionally for a small purchase. Pay the balance immediately. Let them age. Factor 3. Length of credit history, 15%. The longer your credit history, the better. The scoring model looks at the age of your oldest account, the age of your newest account, and the average age of all your accounts. This is why the advice to open a lot of new accounts quickly backfires. Every new account you open lowers your average account age. Multiple new accounts in a short period makes your credit profile look young and thin. The implication: be selective. Only open new accounts when you have a genuine reason, a better reward structure, a lower interest rate, a specific financial goal. And when you open a new account, keep it open. Closing it later removes its history from the calculation. Factor 4. Credit mix, 10%. Lenders like to see that you can handle different types of credit responsibly. Credit cards are revolving credit. The balance changes month to month. Installment loans, car loans, student loans, mortgages have fixed payment schedules. Having both types in your history signals that you're experienced with multiple forms of borrowing. This factor matters less than the first two, but it's real. You don't need to take out a loan, you don't need just to diversify your credit mix. But if you're choosing between a loan and another credit card for a genuine need, knowing that the loan contributes to mix is useful information. Factor 5. New credit inquiries, 10%. Every time you apply for credit, the lender pulls your credit report. This is called a hard inquiry, and it slightly lowers your score, typically by 5 to 10 points. Most hard inquiries fade from their impact within 12 months and disappear from your report after 2 years. The key word in the scoring model is several. 1 or 2 inquiries in a year is fine. 6 applications in 3 months signals to lenders that you might be in financial trouble and shopping desperately for credit. There's an important exception. When you're rate shopping for a mortgage, auto loan, or student loan, multiple inquiries from the same type of lender within a 14 to 45-day window are typically grouped and counted as a single inquiry. The system recognizes you're comparing rates, not accumulating debt. But apply for 5 different credit cards in 2 months? Each one is its own separate hard inquiry. Space out your applications. Here is where most of the money gets lost. These are the beliefs that are common, widely repeated, and wrong. Each one costs the people who believe it in higher interest rates, lower scores, and missed opportunities. Myth 1. Carrying a balance improves your credit score. This is probably the most expensive myth in personal finance. Millions of people deliberately leave a balance on their credit cards every month because they believe it demonstrates they're using their credit in a way that the scoring model rewards. It does not. There is no benefit to carrying a balance. 0. Paying your balance in full every month is identical to carrying a balance in terms of what the scoring model sees. Actually, it's better because your utilization will be lower. The only thing you accomplish by carrying a balance is paying interest. On a $3,000 balance at 22% APR, that's $660 per year going to the credit card company for no reason. Pay your balance in full every month. Every month. There is no credit-building argument for not doing this. Myth 2. Checking your own credit score hurts your score. When you check your own credit score through your bank's app, through Credit Karma, through annualcreditreport.com, this is called a soft inquiry. Soft inquiries do not affect your score. They never have. Only hard inquiries, when a lender pulls your report after you apply for credit, affect your score. You can check your own score as many times as you want. You should check it regularly. Surprises on your credit report are expensive. Myth 3. Closing credit cards you don't use will help your score. We covered this in the utilization section, but it's worth repeating because it's so common and so costly. Closing a credit card does 3 harmful things. It reduces your available credit, increasing your utilization percentage. It potentially removes an old account, lowering your average credit age. And it eliminates a positive payment history from your profile. The only reason to close a credit card is if it charges an annual fee that isn't justified by the benefits you use. Even then, call and ask to be downgraded to a no-fee version of the same card before closing it entirely. Keep the history. Lose the fee. Myth 4. You only have one credit score. You have dozens. There are multiple versions of the FICO score, FICO 8, FICO 9, FICO 10, and variations tailored for mortgage lenders, auto lenders, and credit card companies. There are also VantageScore models developed by the three bureaus themselves. The score you see in your banking app might be VantageScore 3.0. The score a mortgage lender pulls might be FICO 8. They're calculated differently and can differ by 20 to 40 points. This doesn't mean checking your score is useless. The factors that improve one model generally improve others. But don't be alarmed if the number varies by source, and don't assume the score you see is the exact one a lender will use. Myth 5. A good income means a good credit score. Your income does not appear anywhere in your credit score calculation. Not at all. A doctor earning $400,000 who never had a credit card and has no installment loans has no credit score to speak of. A warehouse worker earning $38,000 who has managed credit cards responsibly for 10 years might have a score of 780. The score measures one thing: how you've handled borrowed money. Income is a separate variable that lenders sometimes consider alongside your score, but it is not part of the score itself. Now that you understand the system, let's talk about the deliberate moves that build the score you want. Move 1. Become obsessive about payment history. Auto-pay on every account, minimum payment every single account. Then manually pay the full balance before the statement date when possible. Payment history is 35% of your score. There is no higher leverage move. Move 2. Keep utilization below 10% on every card. Not your overall utilization, each individual card. A card with a $5,000 limit should ideally carry a balance under $500 when reported. The date the balance gets reported is typically your statement closing date, not your payment due date. If you want to optimize this, pay down your balance before the statement closes. Move 3. Request credit limit increases regularly. Every 6 to 12 months, call your credit card company or request online to increase your credit limit. You've been a good customer. You pay on time. A limit increase does two things. It increases your available credit, which drops your utilization percentage, and it's a soft inquiry in most cases, meaning it doesn't hurt your score. If they do a hard inquiry, ask them in advance. If it's a hard pull, decide whether the potential utilization improvement is worth the small temporary score dip. Move 4. Become a thin file builder strategically. If you're starting from scratch, no credit history, the fastest path into the system is a secured credit card. You deposit cash as collateral, usually $200 to $500, and that becomes your credit limit. Use it for small purchases. Pay in full every month. After 6 to 12 months of on-time payments, most issuers will upgrade you to a regular unsecured card and refund your deposit. Becoming an authorized user on someone else's account, a parent, a spouse, a family member with excellent credit, is also effective. Their account's history gets added to your credit file. You don't even need to use the card. The history alone benefits your profile. Move 5. Dispute errors immediately and aggressively. By law, you're entitled to a free credit report from each bureau once per year at annualcreditreport.com. Pull all 3: Equifax, Experian, TransUnion, and read them. Errors are common. Accounts that aren't yours. Late payments that were actually on time. Debts that should have aged off. Each error can suppress your score by tens of points. If you find an error, dispute it directly with the bureau in writing. Include documentation. Bureaus are legally required to investigate within 30 days. If the information can't be verified, it must be removed. One verified dispute on an incorrect late payment can raise your score by 30 to 80 points. That's the difference between a good rate and a great rate on a mortgage, which over 30 years is the difference between paying $40,000 more or less. Here's something that isn't talked about enough. People with the highest credit scores, 800 plus, almost universally use credit cards heavily. They are not avoiding credit cards out of fear. They are using credit cards deliberately as a tool that pays them. The strategy is simple and it has 3 rules. Rule 1. Never carry a balance. The card earns you rewards. Interest charges erase rewards and then some. The math only works if you pay in full every month without exception. This is non-negotiable. If you can't commit to this, the reward strategy doesn't apply to you. Rule 2. Concentrate your spending on your best rewards card. Once you've established credit and have a card with strong rewards, 2% cashback on everything, or bonus categories that match your spending, run your normal expenses through it. Groceries, gas, utilities, subscriptions, everything you'd spend anyway. You're not spending more. You're collecting 2 to 5% back on money you were already going to spend. Rule 3. Treat your credit card like a debit card. Every time you charge something, log the amount. Know your running balance. Don't let the statement shock you. The people who get into trouble with credit cards are people who forget what they've charged and are surprised when the bill arrives. When the statement closes, pay the full balance. That's it. The card builds your credit history, demonstrates responsible utilization, and returns a percentage of your spending to you. It costs you nothing if you follow the rule. Over a year of concentrated spending, even a basic 2% cashback card returns $400 to $600 on $20,000 to $30,000 of normal spending. Premium travel cards with higher annual fees can return $1,000 or more in value for people who maximize their benefits. This is money that flows from the system to you instead of from you to the system. But it only works with discipline. Without discipline, the 22% interest rate turns every dollar of rewards into a $10 loss. Building a great credit score takes years. Damaging it can happen in a week. Here are the invisible threats most people don't see coming. Medical debt. Medical billing is chaotic. Insurance disputes. Billing errors. Charges you didn't know you owed. Medical debt has historically appeared on credit reports and damaged scores, even when disputed. In 2022 and 2023, the 3 major bureaus announced they would remove medical debt under $500 from credit reports and give people a 1-year grace period before reporting larger medical debts. FICO 9 and VantageScore 4.0 don't penalize medical debt as heavily as older models. But not all lenders use the newer scoring models. Always check your credit reports for medical collections. Dispute anything you don't recognize. Request an itemized bill from the provider. Insurance disputes alone resolve many medical collection issues before they ever need to reach your credit file. Apartment and utility accounts. When you move and leave a utility or phone bill unpaid, those balances often go to collections. Collections appear on your credit report. A collection from a $150 internet bill can drop your score by 60 to 100 points. When you move or cancel service, confirm the final balance in writing. Get a confirmation number. Check your credit reports 60 days after any account closure to make sure nothing unexpected appeared. Identity theft. Someone opens an account in your name. They don't pay it. The collection appears on your report. You find out months later when you apply for something and get declined. The best prevention is a credit freeze. A credit freeze prevents any new credit from being opened in your name without your active unfreeze. It's free. It's instant through each bureau's website. It does not affect your existing accounts or your current credit score. If you are not actively applying for new credit, your credit should be frozen. Freeze it today. Unfreeze temporarily when you need it. You have the full system now. Here is what you do with it in order of priority. This week, go to annualcreditreport.com and pull your credit reports from all 3 bureaus. Read them. Look for errors, accounts you don't recognize, and late payments you believe are incorrect. Dispute anything wrong. Then go to your banking app and check your current score. Write it down. You're going to track it monthly from here. This month, set up autopay for the minimum payment on every credit account. Every one. Then immediately set a calendar reminder to manually pay the full balance before each due date. Autopay is your safety net. The manual full payment is your actual strategy. If you don't have a credit card, apply for one. Either a secured card if you're starting from scratch, or a basic no-fee rewards card if you have some credit history. Use it for one small recurring expense. Pay it immediately. This quarter. Call or go online to request a credit limit increase on your oldest, most established credit card. Be polite. Ask if it's a hard or soft inquiry first. If soft, proceed. This one move can significantly lower your utilization ratio. Pull your credit reports again at the 60-day mark. Confirm any disputes were resolved. Confirm no new collections appeared. This year, watch your utilization percentage come down as you pay balances and increase limits. Watch your score move. A 100-point improvement over 12 months of disciplined action is realistic for many people starting from below 700. Calculate what that score improvement is worth. On a $300,000 mortgage, the difference between a 680 score and a 760 score can be nearly 1 full percentage point in interest rate. Over 30 years, that is roughly $60,000 in additional interest paid or not paid depending on which score you bring to the table. Ongoing. Check your reports annually at minimum. Keep utilization low. Never miss a payment. Don't close old accounts. Don't apply for credit unless you have a reason. That's it. The system is not complicated once you understand it. What it requires is consistency. Habits that work quietly in the background while your score climbs and the doors it opens keep getting better. Remember what we said at the beginning. A 3-digit number controls access to housing, transportation, employment, and the interest rates you'll pay on the biggest purchases of your life. You didn't get to vote on that, but you do get to understand it. You get to learn its rules, apply them deliberately, and turn a system that wasn't built for you into a system that works for you. The game is real. The rules are learnable. The people building 800+ scores aren't luckier or richer. They just know what you know now. Start this week. Pull the report. Fix what's wrong. Set up the autopay. Watch the number move. Your future self, the one applying for the mortgage, negotiating the car loan, walking into the apartment, will have a number that opens doors instead of closing them. That's the credit score you're building now.